Chapter 4, The Fear of Being Wrong, the Trader's Real Enemy. Your worst enemy isn't losing, it's needing to be right. Most traders believe their biggest problems are bad entries, poor timing, wrong strategy, lack of discipline. But underneath all of that sits something quieter, deeper, and far more powerful. The fear of being wrong. Not just wrong on a trade, wrong as a person, wrong about your dream, wrong about your abilities, wrong about the story you've been telling yourself about who you really are. The market has a unique, brutal way of pressing directly on that fear. Every tick against you feels like a finger on a bruise. Until you understand this fear and learn to work with it, it will control you more than any chart pattern ever will. When a trade isn't just a trade. On a technical level, a trade is quite simple. You risk X to try and make Y. You place a stop where you're structurally wrong. You place a target where the auction is likely to go. The result is a win, a loss, or a scratch. That's it. Clean, boring, non-emotional, but for most traders, each trade is also something else. A test of their intelligence, a measure of their worth, a referendum on whether they have what it takes, a chance to redeem past losses or failures. The outcome of a single trade becomes linked to their identity, so when price moves against them, they don't just think, this trade might be invalid. They might think, maybe I'm invalid. That's a lot of pressure to put on a single candlestick. Even when you understand edge, location, and structure, something else can still hijack the process. The market doesn't just test your analysis, it tests your relationship with uncertainty and self-judgment. This is where trading quietly stops being mechanical and starts becoming personal. The rules haven't changed, but the meaning you attach to each outcome has. And once a trade carries emotional weight beyond risk and reward, fear doesn't just disappear, it simply finds new ways to express itself on the chart. How fear of being wrong shows up on the chart. You can't see fear on a DOM or a footprint chart, but you can see its effect in your behavior. 1. You hesitate at the best locations. Price taps the prior day high, the value area high, your edge zone, but your brain screams, what if it blows right through? So you wait for confirmation, but by the time you enter, the risk to reward is worse, or the move is over. 2. You move your stop farther away. You don't want the market to prove you wrong, so you place your stop where it's less likely to be hit, not where your trade thesis is actually invalid. You sacrifice risk definition to protect your ego. 3. You avoid pulling the trigger after a loss. Even when your pristine setup appears again, you say, I'll sit this one out. I can't handle another loser today. You protect your feelings instead of protecting your edge. 4. You cut winners too early. The trade moves in your favor, and suddenly you're thinking, I don't want this to turn into a loss, so you bail out at 0.5R when your plan calls for a plus 3R. You are trading not to lose instead of trading to let the edge play out. 5. You add size at the worst possible time. After several wins, your fear shifts. I don't want to miss out. I should be making more. So you size up emotionally, right as your edge hits a normal losing sequence. Now a standard loss feels like a disaster. None of this is random. It's all nervous system trying to avoid one single experience, the sting of being wrong. When these patterns repeat, it becomes clear that something deeper is at work. The behavior isn't random, and it isn't lack of knowledge or discipline. It is a negotiation happening beneath the surface between your trading plan and your need to feel safe. Every hesitation, early exit, and emotional size adjustment is an attempt to manage discomfort, not risk. And once you see that, the real decision point emerges, whether the plan remains in control or whether the ego quietly takes the wheel. The ego's brain. Your ego quietly offers you a deal. I'll protect you from the pain of being wrong if you let me interfere with your plan whenever I get scared. So you skip valid trades, chase invalid ones, move stops, take profits too early, break every rule you carefully designed while you were calm. The ego's goal is not to make you money. Its goal is to maintain a story. I'm capable, I'm smart, I'm in control. Trading done properly threatens that story. You will often be wrong. You will lose money on purpose via predefined risk. You will sit through heat while your thesis is still valid. You will allow the market to disagree with you without panicking. Your ego hates that, so it whispers, "Wait for a little more confirmation. Don't let this winner turn around. You can't take another loss. Just double check everything again. Move your stop. This is just noise." In trying to protect you from the emotional hit of being wrong, it consistently leads you to structurally worse decisions. This is where most traders believe the problem is emotional weakness, when in reality it is a framing error. The discomfort you feel isn't a signal to intervene. It's the cost of participation. Professionals don't eliminate that discomfort. They reinterpret it. And once being wrong is no longer treated as a personal failure, the ego loses its leverage and execution becomes possible again. Professionals aren't fearless, they're reframed. There's a myth that great traders are fearless. They're not. They feel discomfort, doubt, and frustration just like everyone else. The difference is how they frame being wrong. To a struggling trader, a losing trade means I was wrong and I'm a bad trader. To a professional, a losing trade means I executed my edge. This outcome was one of the acceptable possibilities. Pros don't love losing. They just don't attach moral weight to it. Professional traders realize that any edge, no matter how strong, will still have losing trades. Those losses are the ticket cost for being in the game. Trying to avoid all losses destroys the edge itself. They aren't less human. They're more aligned with how markets actually work. Professional traders accept something most retail traders resist. Being wrong on individual trades is required to be right over a series of trades. They don't see losing as humiliation. They see it as fulfilling the statistics. Once loss is understood as statistical requirement rather than a personal failure, a deeper truth comes into focus. They vary conditions that make a trade feel uncomfortable. Uncertainty, tension, and the risk of being wrong are often the same conditions that create opportunity. What feels dangerous is frequently where asymmetry lives, and that realization leads directly to the paradox at the center of edge-based trading, the paradox of the edge. Here's the paradox that sits at the heart of trading on the edge. The best trades are taken in places where it feels like you're the most likely to be wrong. The worst trades are taken in places where it feels like you're most likely to be right, at the edge. So at the edge, the price is stretched, emotions are high, the crowd is screaming breakout or collapse. Your stomach feels tight. Your mind might even scream at you, "This seems dangerous." And yet, when trading at the edge of price discovery, your stop can be tight and obvious. Your target can be back to value or well-defined. The losers are heavily concentrated in one zone. And if that zone rejects, the unwind can be quick and powerful. But in the middle, price feels calm, things look confirmed, you don't feel silly for entering, your stomach relaxes. Everything in you says, this feels safer. And yet, your stop tends to be wide and arbitrary. Your target is often close and hopeful. Nobody is desperate. No one is truly stuck. You fear the edge, but the risk asymmetry lives there. You feel safe in the middle, but that's where your account bleeds slowly. To cross this gap, you must start seeing fear differently. This contrast is not accidental, it is diagnostic. The discomfort you feel at the edge and the ease you feel in the middle are signals, not flaws. They reveal where risk is concentrated versus where it is merely disguised. The market trains you to associate comfort with safety and tension with danger, even though the opposite is often true. To trade the edge consistently, you don't need to eliminate fear. You need to understand what it's pointing to. Fear as a location signal. Instead of asking, "How do I get rid of fear?" you should be asking yourself, "What is this fear trying to tell me?" Not about your worth, but about the auction. You'll notice something if you start paying close attention. You feel least fear when trading small size in the middle of the market. You You feel the most fear when sizing responsibly at the extremes of price. This is backwards from what you actually want, but it contains an important clue. Fear tends to spike exactly where the best trades live. Why is that? Well, because you're closer to obvious invalidation, you're taking the other side of the crowd, you're acting where others are emotionally overcommitted. You're entering before the move looks confirmed. Your nervous system reads this as danger. Your edge reads this as opportunity. Once fear is correctly interpreted, the foundation of decision-making has to change with it. Its discomfort can signal opportunity rather than error. Then profit can no longer be the sole measure of correctness. Otherwise, every losing trade will still feel like a mistake, even when it wasn't. To operate at the edge without self-sabotage, you need definition of right that survives randomness, variance, and short-term outcomes. Redefining what it means to be right. Right now, your brain probably defines being right like this. My trade made money, therefore I was right. That definition guarantees emotional chaos because you can follow your rules and still lose. You can break your rules and win. You can make horrible decisions and get rewarded. You can make excellent decisions and get punished on that trade. You need a definition of right that doesn't fold under randomness. So try this instead. I am right when I execute a valid edge at the right location with predefined risk, regardless of the outcome of this individual trade. In that frame, a losing trade can be right. A winning trade can be wrong. You shift from outcome judging to process judging. Your new scoreboard, your new scorecard becomes, did I trade at a valid edge? Did I place my stop where the trade thesis is clearly invalid? Did I size correctly relative to my plan? Did I enter and manage according to my criteria? If yes, you were right. The P&L will take care of itself over a series of trades. A simple practice, pre-committing to being wrong. Here's a practical way to start dismantling the fear of being wrong. Before you enter a trade, write down, physically or in your platform notes, question, where is this trade invalid? Answer, if the price closes above or below X, I am wrong on this idea. Question, how much am I willing to pay to find out? Answer, I am willing to lose 1R or X dollar or X percentage to see if this edge plays out. These two questions help your mind normalize losses. With the healthier definition of being right in place, the next step is to train your nervous system to tolerate being wrong before the market forces the lesson. If this trade loses, it will be one of the many expected losses within a profitable series. Then as you place a trade, say to yourself, I am accepting this loss in advance as the cost of my statistical edge. If the trade works out, my statistics are grateful. If it loses, my statistics are grateful. You are not just accepting risk in theory, you are emotionally consenting to being wrong on this trade, so you can be right over many trades. This is what it feels like to take your ego out of the line of fire. Once you have truly made peace with being wrong on individual trades, a subtle shift occurs. Losses no longer dominate your attention, but avoidance does. The discomfort moves away from taking trades to missing them. And this is not a regression. It is evidence of growth. It signals that fear is no longer centered on loss itself, but on failing to act when your edge is present. At that stage, the real threat is no longer being wrong. It is not playing at all. The new enemy, not being wrong, but not playing. At the beginning of your journey, the biggest emotional enemy is being wrong. But as you mature as a trader, your enemy slowly changes. It becomes not playing your edge. You'll start feeling worse when you skip valid trades at the edge, break your rules to protect your feelings or ego, watch perfect setups unfold without you because you were scared. Here's an important sign that you're growing as a trader: when you learn to sit back and to take a valid loss. Learning to accept valid losses means your identity is shifting from I'm a person trying not to get hurt to I'm an operator running a probabilistic edge. At that point, the fear of being wrong doesn't disappear. It just stops driving. Fear becomes background noise, like static on a radio you've learned to ignore while you stay tuned to the real signal. Location, imbalance, structure, risk. The real enemy named. So let's name it clearly. Your real enemy is not losing. Your real enemy is making decisions to avoid the feeling of being wrong. Because that leads you to trade the middle instead of the edge, overcomplicate charts instead of seeing structure, over-leverage instead of maintaining clear risk, cut winners and let losers run, break your own rules, slowly eroding trust in yourself. The market doesn't punish you for being wrong. In truth, it punishes you for being undisciplined, being misaligned with how auctions actually work, refusing to accept a loss as part of the game. When these elements are aligned, location, imbalance, structure, and risk, clarity replaces confusion. Decisions become simpler, not easier, and responsibility becomes unavoidable. At that point, it becomes impossible to keep blaming the market, the tools, or the outcomes. What remains is the real source of sabotage, the subtle, reflexive decisions made to escape discomfort. And once that is seen clearly, the true enemy can finally be named. In the next part of this book, we're going to start building something much more solid, a view of markets that doesn't depend on your feelings, your need to be right, or your indicator of the month. We're going to step into the world where professionals live, where markets are auctions, value acts like gravity, and edge is a place where someone must be wrong. Once you see the market in this way, being wrong on trade stops feeling like a personal failure and starts feeling like just another brick in structure of long-term profitability. Okay, so the next chapter is chapter 5, probability versus prediction, the lie that cost fortunes. Edge is the acceptance that outcomes are uncertain, execution is not. But I'm not going to record that. If you enjoyed these first 4 chapters, please feel free to pick up a copy of my book on Amazon. It would greatly support the channel and spread the word of the Smart Money Futures brand I'm building on YouTube. Let me go back over the table of contents so you can see the other chapters in the book before you buy it. So chapter 5, probability versus prediction, the lie that cost fortunes. Chapter 6, foundations of volume profile and auction market theory. Chapter 7, markets are auctions, not opinions. Chapter 8, value, fairness, and the middle of nowhere. Chapter 9, where the fight matters, value boundaries. VAH, VAL, and IB extremes. Chapter 10, market profile and TPO, making the auction visible in time. 11, date types and auction narratives, reading the story in TPO. Chapter 12, fusing market profile, volume profile, VWAP, and CVD in one playbook. Chapter 13, the birthplace of reversal, the edge of price discovery. And there's many more chapters. So go ahead and pause the video and look over these chapter headings. Sorry, my voice is getting a bit raw. All right, well, thanks for listening to this mini audiobook of my book, Trading on the Edge. I hope you enjoyed it. If you did enjoy it, I promise you will absolutely love the full book. The entire framework that I teach on my Smart Money Futures channel all comes from the Trading on the Edge book. So check it out. You'll like it. Thanks for listening. I will see you in my next video. Thanks.